So when we're looking at price of bonds, a lot of time when we look at price of bonds, like because there is a secondary market for price of bonds as well. One is for primary markets, the second one is the secondary market. What's the secondary market? For example, let's say government issued bonds or securities, and let's say I bought a 5-year security which gives me a 12% return. Okay, but in the second year, let's say I need money, can I sell this in the market? And the answer is I can go to the market and sell my bond and get money. So the cool thing about government securities is that you don't need to wait for 5 years for the bond to mature to get your money back. You can get your money back very quickly from a secondary market, from another market where bonds are bought and sold. And we need to know what that price will be at which you will buy or sell security. Okay. So when we say this, that when you look at interest rates, uh, there is an inverse relationship between interest rates and price of bonds. Just to recap, the bonds or securities. Remember, securities would have a interest rate, like, or a rate of return. I should call it rate of return. They would have a rate of return of, for example, 10%. They would have what we call tenor or duration of, let's say, 5 years, and they may have what we call face value of, for example, $100. So somebody who's buying this will first pay $100, okay, and then he's going to keep it for 5 years, and every year this bond is going to give you 10% return. Make sense? But what if I tell you in the market? What if I tell you the interest rates are, for example, interest rates are very high, like 15%. Okay, if interest rates are 15%, which means if you give your money to the bank gives you 15%, but this bond is only giving you 10%. Do you think this bond? Do you think this bond will be in demand? Why? Because the rate of return from the bonds is lower than the interest rates. So when the interest rates are high, one would say the demand for bonds will be low. And when demand for bonds will be low, what happens to the price of bonds? Price of bonds will fall. Very good job. If price of bond fall, and guys, if you are a speculator, not an individual who buys differently, but a speculator. A speculator is somebody who buys at a low price and he sells at a high price. He's got money, he's got a lot of liquidity. As soon as the property prices or asset prices start to go down, he's the one who buys. Whenever the share prices are going down and you're selling it to somebody, right? In the market, who is that somebody? That somebody could be your speculator, who is always willing to buy at a low price. Okay, so when the price of bonds falls, the speculator buys bonds and therefore hold less money balances. Okay, he will be holding more bonds and less money balances. Why am I talking about speculator here? Is because I was just wanted to explain the idea that high interest rate would mean low price of bonds, and if low price of bonds means there's an inverse relationship, but low price of bond means if you're a speculator, you will be buying bonds and holding less money balances. So why will a speculator buy bonds when the rate of return is low than interest rate? Because he's not interested in the rate of return. What he's interested in is that today the price is low, tomorrow he's going to sell it at a higher price. He's not you and I who are basically putting our money for rate of return. If you're a speculator, you want to sell the bond at a higher price. Make sense? So low interest rate would mean high price of bonds. That's an important thing to understand. Vice versa, guys, if the interest rates are low, like 5%, then what do you think will happen to demand for bonds? Demand of bonds will be high. So demand for bonds will be high, especially those with a return more than 5%. Exactly. And the price of bonds will rise. Exactly. Speculator sells bonds and hold more money balances. Do you guys get that? You agree with me? So, guys, there's an important part that we just figured out. There's an important point we just figured out, which is basically to do with, to do with how speculators will be behaving. Because remember the speculative demand for money? If you go back to speculative demand for money, I want to draw the diagram again and come back to this text, because speculative demand for money looks like this. If I have interest rates here, and if I have quantity of money here, then this is how it looks like, right? Which it says this: when the interest rates are really high, remember when the interest rates are high, price of bonds will be low. And if price of bonds are low, what is the speculator doing? Buying bonds, which means the money balances in your hands are very less. Let's call it Q naught. Isn't that you're holding very little money? Why you were holding very little money? Because you must be buying bonds. When you have bonds in your hand, money is gone to people who are interested in buying those bonds. Similarly, when the interest rates are low, then the quantity that you're holding is high because you must be selling bonds. So that's another explanation of the speculative demand for money. That high interest rate means low price of bonds. Low price of bonds means buy bonds. Low interest rates means high price of bonds. High price of bond means sell bonds. And when you sell bonds, of course, money will come into your hand. You'll be holding a lot of money balances. So that's an explanation of speculative demand for money. Yeah, you want to copy this? Do we get that? Does that make sense, guys? This is a very important thought because a lot of MCQs. So, guys, what is liquidity trap? Liquidity trap is basically an idea which came forward because of Keynesians. Keynesians came up with this idea that, when you look at speculative demand for money, they said it's very responsive to changes in interest rates. If people believe that the rate of interest will rise, understand, if you believe that the rate of interest will rise, then you are also believing that the price of bond will fall. Isn't that true? If you know that rate of interest is going to go up, you know that price of bond will fall. And if you're a speculator, knowing the price of bond will fall, you will want to buy now or buy later. You want to buy. So if you believe, so price of bonds and other securities will fall, few people will want to buy them. Why would people want to buy them? Because they know the prices will about to fall. If I tell you this, there is a property or there's a house, if you buy right now, in 10 days the price will fall. Will you buy it? You'll be like, I'll wait till the price goes down. Isn't that true? So if a speculator is believing that interest rate will go up, he knows the price of bond will fall. For him, this is the time to sell his bonds because tomorrow the price will fall. But he's not going to buy. He's going to buy later when the price actually goes down. Isn't that true? Similarly, so instead of few people will buy them, instead there will be a very high demand of liquid assets. So when you're not buying bonds, you're holding a lot of cash. Why are you holding a lot of cash in your hand? because you know the price will fall tomorrow, and when the price falls, you will be able to buy it. So your reason of holding cash is because you are have a belief that because the interest rate will rise tomorrow, the price of bonds is going to fall, and you're going to sort of have. So if government says we are about to increase the interest rates, a lot of time that would mean the price of bonds or securities will go down. Why? Because people will actually be waiting for the interest rate to go up, price of bonds to go down, and therefore that's when they buy if they are speculators. The demand for money will therefore be very elastic. What we say is this, that if you look at from that perspective, they came up with this idea. So I want to draw that idea. They came up with this idea that if you look at the liquidity preference curve, the liquidity preference curve actually look like this. I'm going to show you in MCQs. Um, it looks like this kind of a curve, a flat curve in the end. So they call this the liquidity preference curve. They say this, that at some particular interest rate, let's say R naught, your liquidity preference curve becomes completely flat. And at the higher interest rates, it's a very responsive curve, but then it becomes very unresponsive. And they came up with this idea that, think of this way, guys, if the interest rates are really, really low, or they are almost at the rock bottom, okay? If the interest rates are at the rock bottom, what will happen to the speculator? Will he demand securities? No, think of this way. If the interest rates are really, really low, right? This would mean they can't go any lower than what it is right now. If the interest rates are really low, they can't fall below R naught. If they can't fall below R naught, what will happen therefore to the price of bonds? If the interest rates are really low, the price of bonds are really high, which means they can't rise any further. Which would mean if you are a speculator, you know that if you buy the bond, this is probably the highest price of bond. Isn't that true? It's a very important thought to understand that if the interest rates are really low, the price of bonds will be really high. And if they can't go below R naught any further, which means the price of bonds will not rise any further. From a speculator purpose, you won't buy bonds. Isn't that true? So when you look at money demand and money supply, what this theory says is that when you make your money demand, they say this, that if at a very low interest rate, if the government increases money supply, okay, government decides to, through the central bank, increase money supply. Normally when you increase money supply, interest rates goes down. Isn't that true? But what they say is this, that, sorry, yes, so they say, arguing this, that agar money supply बढ़ती है, if the money supply goes up, they say this, that the economy basically is at this kind of a stage where interest rates are so low that people, when you increase money supply, you increase money supply with the hope that people will spend money, but people will not spend money. In fact, what happens is